The UK is the latest housing market undergoing price corrections, with predicted falls of up to 18% this year. But while most homeowners are locked into a falling market, some cunning investors are looking to profit from the downturn. How? Quite simply, they bet on it.
Spread betting on the house price indexes has been in existence since 2002. The spread fair market has been probably the most successful one because it allows clients to come and make the prices in the market.
The market is based on the Halifax House Price Index that publishes the average monthly price of UK homes, and this is used to verify the bets. Clients bet against each other on future prices, either going short, betting the price will fall further than predicted, or long, anticipating a smaller fall. But this is a dangerous game.
What one person gains, another loses. So it's zero sum in the aggregate. So to make any money, you have to be smarter than the market. And of course, on average, people can't be. Things are slightly worse than that, because the market maker, the organizer that offers these services, also takes a cut. So in fact, the people that play in the markets, on average, get a negative return.
Of course, for the market maker, the more activity, the bigger the commissions.
As with any exchange, the more activity and the more liquidity and the more flow we see, the more profitable the business is for us.
Recent uncertainty in global markets has certainly fueled demand.
Over the last 6-8 months, we've seen enormous growth, particularly at the beginning of this year, where there was a huge amount of uncertainty with world markets, how the credit crisis was going to play out. We're seeing sort of growth of 400–500%.
The concept of hedging house prices is looking increasingly more attractive, particularly to buy-to-let investors locked into their investment portfolio. So while the price of your house may be falling, the hedge may just be the bet that saves your bacon. Some buy-to-let investors use the platform as a way to hedge their exposure. Some players have already sold up their bricks and mortar and are playing the percentages virtually.
My exposure is equivalent to probably around 10 or 15 properties in the sort of London area. So it's effectively like being a sort of medium-sized buy-to-let investor. Although where a year or two ago I would have been long those 10 to 15 properties, I'm now more on the short side.
It is this flexibility and instant trading which seem to be the major draw.
Exactly, yes. You have the opportunity to trade both sides of the market. Rather than just hoping that things go up, you can actually anticipate a possible downturn and trade on things going down.
As well as being exempt from capital gains tax, you can also buy exposure with around a 15% deposit. However, your losses, or your winnings, could be much more than your initial stake.
These things are capped, the losses, at some level, but that could be much more than you put in initially.
The global interbank property derivatives market also launched in 2002 and is now worth $40 billion. But with a minimum stake of $10 million, it is the same game on a different scale.
I don't think it matters really what the price trend is. The ability to trade those two aspects of property as a asset class in a simple on-paper form is such an elegant idea that I think it will grow whether house prices are up, down or sideways.
But short or long, one thing's for sure. These days, there's no shortage of stock.